Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for, and what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent registered investment advisory firm and fiduciary. If this is the first time that you are catching the radio show, welcome. If you are a regular listener, welcome back. If you're a client, welcome. If you're catching this on the podcast, that's great. We love to see the numbers going up and to the right. I think the job of an advisor is to always make sure that we or you have something in your portfolio that can deliver positive returns, even if the market is down. Now, down to a point. And as you know, the strategies we use, they have 30% downside protection before you don't get paid your coupon payment. Now, that is for your bond replacement. So we'll go over that today. We did price a note last week, so I want to just review what that is, what that's not. More and more people listen to the radio show are reaching out because of that, and I think it's phenomenal. So any questions you have regarding the investments you have, the market, challenges, income, financial planning, just please obviously feel free to reach out. 630-492-1912, 630-492-1912. Market volatility is back. That is, I think, a good thing. Many people are very, very concerned, especially investors who don't have anything inside of their portfolio that can weather the down market. We see it over and over and over again. As you know, we do the radio show on Saturdays and Sundays here in the Chicago area. We are headquartered in Naperville. So we also have the opportunity to reach out and talk with many, many new investors that are not comfortable with their current situation. And they call in and they have an initial conversation with us, and generally they're starting to worry more and more about volatility. So if that is an issue that you're concerned about, if you're not 100% confident that your portfolio could handle a meaningful market correction, meaningful to me is really any loss, but in most people's eyes, it's 10, 15, 20%, then again, give Paige a call. Let's have our initial talk and see if we can help you out. So 630-492-1912. There is a lot of panic. People, use that word often, and that doesn't mean that we're trying to scare people, but there is panic underneath the surface. And I think when you look at what investing is, many, many advisors, many advisory firms, they all talk when the markets are up, 10, 15, 20%, 30%. Certainly in the mid-20s, like the last couple of years. They talk about risk. They talk about how your portfolio can weather the downside, that the diversification that you have is going to prevent you from having stress or worrying when the markets are down. And then when the markets drop, and then when we see volatility, that's when you start to see that you really have nothing inside of your portfolio that could do well or even make money in a down market. And those strategies do exist. And it's my job as a fiduciary. It's my job as an advisor. It's just my job in general to get the message out, because there are a lot of lazy advisors in this industry. There are a lot of lazy advisory firms that they're more concerned about scaling their business, scaling and bringing in new clients to increase their revenue. And we often talk a lot about the banknotes, and banknotes they're good. In my opinion, they're great, but they may not be for everybody. But our job is to deliver the data and then let you decide. And when we have these initial meetings, one of the more common responses that we get when we're talking about our protected growth strategies, again, we believe in protected growth, growth plus, and then alternative tax reduction strategies. So 4 distinctly, uniquely different strategies. But when we talk about the banknotes, generally what we're going to hear is, why doesn't everybody do them? And that's a very, very valid and very astute thought from many investors that we talk with. And the answer is, I wish all advisors did it. I don't know what the statistics are. I do know in the Chicago area, we're certainly towards the top as far as volume in what we do. And it's very simple. My thought process is that I know they require a lot of work, and I do know that they're very labor intensive for the advisor. And when when advisors rather have 100 clients, 300 clients, 500 clients, they're very hard to implement. And so that's why most advisors, in my opinion, generally stay away from them. And if you haven't done a strategy, it doesn't matter what the strategy is, as you are young in your career and then mid-career, very rarely are you going to incorporate anything new late career. And you have to ask yourself why, because I think the job of an advisor is to bring to the table cutting edge strategies and then let the clients decide, let the investor decide if that makes sense for their situation. I'm tired of these asset allocated models. I'm tired of 9 out of 10 advisors simply telling clients it's time in the market. We're going to give you some goofy risk tolerance questionnaire, and it's going to state that you're 60-40, 70-30 for the rest of your life. And that's a challenge. And you don't know the deficiencies of that portfolio until you start to lose money or the market's correct. And then the answer is, well, just sit and wait. You're going to be okay. We're on a mission to change that. And we have done a very good job. And we've gotten very aggressive about the marketing of that message this first quarter. And you're going to see a whole lot more coming over the next quarter or two and years to come, because you don't have to lose money. It's just unnecessary if you, most people that are listening to the radio show that have an asset allocated model, and what that means is if you've taken a risk tolerance questionnaire and you've listened to an advisor and you're working with an advisor and they tell you you're going to have some equities, you're going to have some bonds, that's an asset allocated model. So you own two things. You own stocks and bonds, and you have to ask yourself, how is that done for you? Now, the equities have done very, very well, but look at your safe money. Look at the bond money. Look at, what that's done over the last 5 years. And what happens when the market's correct is that money that you've probably lost, 10, 15, 20%, depending upon what strategies you've used, is that the most efficient way to manage money? And you look at a 10-year bond fund, bond ETF, I don't care, pick your favorite one and go look at the 10-year performance number, and I almost would guarantee that it's under 2%, probably 1.5 to 1.7% annualized. So that's not even keeping up with inflation. Then you tack on taxes. I mean, that's a negative investment. So banknotes are something that we are going to basically stand outside on the corner and hold signs, right? I mean, because, I say that kind of obviously jokingly, but I mean, the radio show is what the radio show is. It gets the message out to the masses. And when you look at a strategy that's backed by the largest banks, it could be JP Morgan, Citi, Bank of America, Morgan Stanley, UBS, et cetera. We are only using what we would consider to be the two large to fail banks, the best credit quality banks in the world. And you have a strategy. The last one we did on midweek last week priced, we'll just call it 12.5. It was a little bit over that, but 12.5%. And you get that monthly coupon. So they take an annual number, 12.5%. You get monthly coupons. So take the 12.5 divided by 12. And each month you will get paid that coupon payment as long as the indexes that note is tracking is not down 30%. Think about that, 30%. So you have 30% buffer before you don't make money. And again, this is our safe money. This is our bond replacement. So compare that if you do nothing else. Now, many people would think that could be an equity replacement. And, I guess there's, that for some, that's okay. I mean, last year when the equity markets, are up 25%, 12.5, 13 probably doesn't look very good. But as a bond replacement, I challenge you to compare that. And if and when we do see the markets go down, which we will, how refreshing would it be to work with a proactive advisory fiduciary firm that is utilizing the most, I hesitate to even say these are cutting edge because they're not. I mean, they may have been cutting edge in the early 2000s. They're just not a mass marketed strategy. And it's a private bank strategy. A lot of times when we get investors that are coming over from a bank, we'll hear, well, why doesn't, my bank, why doesn't my advisor, share these with me? And obviously I can't answer that, but The good news is that we do. And so if you would like double-digit returns with 30% downside protection, now again, it does come with a prospectus. You need to look at it. Past performance isn't indicative of future results. I don't know if it's right for your situation. We want to make sure that we're giving you all of the qualifiers, but it is certainly worth reaching out if you want to make sure that a bucket of your money, if and when the markets go down, can actually do well. So 630-492-1912, 630-492-1912. And for those people who are buying annuities, lifetime income annuities, and you want to compare side by side banknotes versus those, oh my goodness. I mean, there's a lot of annuity guys on the radio. You know that, I know that. We all hear the same shows, right? They may not say it, but they know that they're selling you an annuity even before you walk in that office. And you have to think, if you're buying lifetime income annuities, you have to think, what will inflation do to that income stream 5, 10, 15 years down the road? Again, the insurance companies understand that they're going to, in my opinion, governor the growth, and then limit your withdrawals. So when you look at an annuity, and especially if you're going into somebody on the radio and they're going to show you an illustration, please send me that illustration before you do anything, because I will tell you 100 times out of 100, well, let's give it a qualifier, 99 out of 100 times, it's my belief that that illustration, given that those investments are back-tested and weren't around, will never, ever come close to meeting your expectations. So I will look at that annuity and I will do a side-by-side cash flow analysis of income generation between banknotes and the lifetime guaranteed annuities. Now, here's why people running around on the radio are selling those lifetime annuities. They pay great commission, 7%, 8%, 10%. That is a heck of a great commission right off the bat. And as a fee advisor, where as a fiduciary, we charge an annual fee, and if our fee is 1%, 1.5%, 1.25%, 3/4, whatever that is, man, we're not making what that annuity advisor, that annuity guy is making. It's going to take us 10 to 12 years in many instances, just to make the same amount of commission that they're making. So a lot of times, unfortunately, the commissions dictate what advisors are selling, and that's an issue. So if you're looking at, if you own, if you're being sold a guaranteed lifetime income story, let's compare cash flow. Let's compare how that is going to be affected with inflation. And I promise you, you're going to get an objective opinion. And now, again, most people will say, well, you don't like annuities. And that couldn't be further from the case. I mean, the annuity that we use, which is also in our protected growth bucket, is a 5-year annuity. And that 5-year annuity, it doesn't have any income component. It's a pure growth story. And it's phenomenal. Many people love it. Again, it's about principal protection. It's a bond replacement. And that strategy is 5 years. You can own it forever, but it is a 5-year commitment, and it's simply tied to the S&P. The S&P has been around forever, so it's not one of these new volatility-controlled indexes that looks really good on paper, but in actuality, in the real world, it's not going to work in any way close to what they illustrate. So this is very simple. You get up to 10.25% of the S&P 500 on an annual basis. That is it. Up to 10.25% of the S&P 500 on an annual basis. When you get a gain, the gain's locked in. That a 10% cap has beaten the S&P if you started the investment in 99. Now we had 01 and 02, obviously, where the markets dropped right away, but who's to say that we're not in that area today or that market today? So again, we're not against annuities, we're against the wrong annuity. And there's many people that we meet with. We had a client in this week and he's like, my goodness, if we can get 10.25% up to 10.25% with absolutely no downside risk to principal on an annual basis, and when you get a gain, that gain's locked in, never to go back down in future markets, that's, very appealing to people. Now, I want you to realize that that's a bond alternative because we still want equity money, but what would you rather have in the bond market? Losing money or the two strategies that we talked about, that one is principal protected, the other you're still going to make double-digit returns as long as the markets aren't down 30%. So we're going to talk a little bit more about some cracks that we're seeing in the market. If you'd like to have a call with us this week, 630-492-1912, 630-492-1912.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent registered investment advisory firm. First-time listener, welcome. If you've listened to the show many times, welcome back. If you're a current client, we love that you listen. Thank you. Our job is to make sure that if and when the markets go down, maybe they'll never go down again. Maybe the markets will continue to average 20% plus a year. And my goodness, I would absolutely love that. Because remember, when we look at investing, we take a very unique strategy, a very different approach than what most advisors are going to do. We have kind of what we call sleeves, buckets, whatever, swim lanes, call them what you want, protected growth, growth plus, and alternative and tax reduction. So we're going to talk about tax reduction this segment. April 15th is coming up, but tax planning is a year-round activity. We don't want to start planning for tax reduction strategies, investments, and trying to reduce your active and passive taxable income at the end of the year, the last week of the year. We want to start looking at it now. And you have to understand that there are strategies that if you're with a big bank, if you're with a big brokerage firm, I don't care if you have $10 million with them, $50 million with them, you are not going to have access to these strategies that can greatly reduce your taxable income. It's one of the benefits of being an independent fiduciary. Independent means that, well, it's good and bad, but you have to make sure that, you have a good investment first and foremost, that it's very transparent, that it's, a third-party administrator, that any investment outside of the public markets is audited, third-party accounting. I mean, those are some very, very big points that you have to make sure that you're checking the box when you're looking at investments that are outside of the public markets. But these are strategies that can reduce your taxable income by up to $90,000 per $100,000 invested, and that's active and that is passive. So if you sold a business, sold a building, if you're a high wage earner, a physician, an attorney, whatever, make $500,000, $1 million, $2 million, $10 million a year. These are strategies that you need to incorporate, in my belief, in my opinion, inside of your portfolio. And I would challenge you to find another advisor that can bring you strategies that can reduce your taxable income by up to $90,000 per $100,000 invested. Now, we're not tax advisors. We certainly can't provide tax advice. So best practice is always, before you invest, is to make sure you reach out to your tax professional. These tax benefits however, are very, very cut and dry. So 630-492-1912, 630-492-1912. The markets. So we did have volatility this week. I think, a lot of volatility in at least, the beginning of the week happened. And it's amazing how fast, risk can turn on. It can be turned back on in a second. And, generally the old adage is, markets stair step up and the elevator down. And that's okay, in our opinion, because there's one thing we can't control. We can't control what's going to happen in the market tomorrow. My thoughts, my beliefs absolutely are irrelevant. Yours are irrelevant. The advisor that you're working with, theirs are irrelevant. Markets are going to do what the markets are going to do. I can't tell you how many people that I've talked with that have missed the run-up the last 3 years because the markets had to correct. They had to correct. They had to go down. Well, they didn't. And you probably missed 50, 60% on the upside. And it's unfortunate because when you're using gut feel, when you're using, what we think should happen, it just doesn't matter. And that's why, in my belief, you have to make sure that, first of all, that you have a financial plan. Again, I believe that we have the best financial plan that you're going to find. It is the most comprehensive financial plan I think that you're going to find, not only on future cash flow, RMDs, and inflation projections, but also on the tax side. The tax software that we use is going to impress you. And when we look at the Roth conversion story, most people don't understand. If you have an IRA, $500,000, $1 million, $2 million, $3 million IRA. Once you start having to take RMDs, whether it's 72 and a half, 73, 75, whatever that age is, you are going to be shocked at the tax that you're ultimately going to have to pay. So we want to show you how we can help mitigate that by doing Roth conversions. Roth conversions have been around forever, but I don't think people fully understand. I think that they think that they're going to ultimately be in a lower tax bracket when they are older. And again, we don't know where taxes are going, but it's my belief that over time they're probably going to go up. But again, that's just an opinion. But when you look at, if you have a larger IRA, again, $500,000 to $5 million IRA, those RMDs that you're going to have to take, they could put you in the highest tax bracket or near the highest tax bracket. And it's just not an efficient way to certainly pass on your assets to future, generations if that is ultimately a goal for you. But we have to look at the Roth conversion story, and we have to show you, we have to map out every single year how much you can convert. We have to make sure that you're maximizing in your conversion whatever current tax bracket you're in. Now, most people are going to say astutely, hopefully, that, well, that's taxable income in the year that I do the conversion. And that's very true. But what if you had an investment that you can invest in that could offset a lot or all of that additional taxable income from the conversion? And that is where we really add value. You don't need us to do a conversion. Anybody can do a Roth conversion. That's simple. But can you invest some of your money in an investment that can reduce your taxable income by up to $90,000 per $100,000 invested? That is the question that you have to ask yourself. And if you can, well, then you need to call me, because I need to know what it is, because I don't believe that I don't know a single advisor that is offering the strategy in the energy space like we are. But if you don't have that, if you have not been shown tax reduction strategies, which again is in my belief is the overlooked area of financial planning, then you need to reach out to us, and we need to have that conversation. 630-492-1912. So back to the markets. I mean, current situation, who knows? Again, you look at it, some days it seems like stocks are falling, like the trade war is officially back. The U.S. dollar is falling like the trade war is over. Crypto is falling like the bear market has just started. I mean, look at that. I mean, that is just, has been very, very interesting. This last week, Treasury yields are following like rate cuts are back, but yet can they really cut rates because we have significantly high inflation? Oil prices are down just a tick, like we're entering a recession. Gold is falling like we're on track for a soft landing. So they're just, it's just crazy right now out there. And the markets are, they're just very uncertain, and there's just a lot of worry, and there's a lot of unknowns. And again, we can't control the market, but what we can control is we can control how your portfolio is constructed. And if you have an asset allocated model, I think you're going to be potentially in for some surprises. Again, we see more and more advisory firms not talk about performance, especially here in Chicago. There's some in suburban Chicago that are, love to tout how big they are, how many employees they have, and how much money they manage. But yet you look at their raw performance and it's below market, not only just a little below market, but significantly below market. So we want to shine a light on performance. We want to shine a light on, are you actually getting any value for, the service, is there value, that you're receiving from the advisory firm that you're working with? What are you getting for that 0.5%, 1%, 2%, whatever that fee is? Are you getting proactive strategies that can, like we utilize, that can deliver, double-digit returns as long as the markets aren't down 30% with the banknotes? Are you getting strategies that can reduce your taxable income by up to $90,000 per every $100,000 invested? And it is in the energy space. And so it is a real asset. It is a non-correlated asset. So those distributions are going to come independent of what's going on in the stock and bond market. And we do target double-digit distributions in that strategy. So if you had a portfolio where, just think, if you only added what we have, our protected growth bucket, which are the banknotes and the principal protection strategy, and then you had on the other side of the portfolio the alternative / tax reduction / real asset strategy, well, you may have 30 to 40%, maybe even 50% of your money that if the markets go down, that your portfolio is not going to be directly affected. Think about that. I mean, so when you're calling your current advisor, if we do see the markets drop 15 to 20%, and they're going to tell you just sit and wait because your plan says as long as we average X, you're ultimately going to be okay, which blows me away, like that a client should expect or, be okay with that kind of rationale. But again, there's advisory firms that are, grossly underperforming on the performance side, but lean on, a plan that, anybody can go and get by, almost just, leaving money in just corporate bonds and money markets. But, that's a topic for another day. But the question is, if you call your advisor, do you want to have the conversation that, well, you just got to sit and wait. It's okay to lose, 20, 30, 40% of your money. Or would you rather have the conversation that, yes, our equities are down. There's absolutely no doubt about it. Equities are equities. Equities are long-term. Equities are going to have, periods of up, periods of down. Now, our equity strategies have greatly outperformed the S&P 500 over time. Again, that's past. That's not forward-looking. So, take that as, for what it's worth. But they're going to go down. I mean, they're just, there is no doubt that equities go up, equities go down. But what if you had a large chunk of your portfolio that we could point to, that we could say, well, you know what, the S&P is not down, or the indexes that your banknotes are tracking are not down 30%. So you're actually still making money. Think about that. Still making money, and the markets are down 20, markets are down 15, markets are down, 29, whatever that number is. But you have 10%, 20%, 50%, whatever that number is for you, that is still generating positive returns. And so what that does is that offsets, obviously, the market volatility. So if the markets are down, well, the equity markets, your equity buckets are down. Well, maybe this bucket is up. And if you, believe in compounded returns, if you believe that the best way to grow assets over time is compound interest, compound returns, well, the greatest destroyer of those returns, of interest, are portfolio losses. And so you must make sure that there is no option. You're in your 50s and 60s, or you're retired. You have no second chance. You have no option to, in my opinion, it's my belief that if you see 20, 30% correction, good luck living with that. I mean, the stress that comes with that, the uncertainty that comes with that, and it doesn't matter if you have 5 million, 10 million, 1,500,000, it doesn't matter. You have to ask yourself, what am I paying for? So many advisors out there are just doing these goofy asset allocation models. And here's the secret. You can do that on your own. You don't need an advisor. You don't need an advisor to handhold you when the markets are down 20 to 30% and to tell you, well, that your plan, as long as we average 6% or 7% or whatever that number is, you're not going to run out of money. I mean, that's just nonsense in my opinion. But that's what's out there today. That's the bulk of the advice that you're going to get. And I think that's why we've seen the growth that we've seen. Because, in every industry, real estate, technology, and pick your industry, technology wins, right? And advancing technology wins. But yeah, when it comes to investing, advisors are still running around using the same asset allocated models that were popular in the 80s. And why are they doing that? Because it's great for them. They can scale their business, their return that on their time is so much greater than actually implementing cutting edge strategies that do candidly take some time and some effort to implement. So again, as you know, it's my belief that most advisors are not going to invest the way that they are recommending their clients to invest. Very, very few advisors who live and breathe this on a day-to-day basis are going to do just a basic asset allocated model that they are recommending to you. And the question is why? Well, we'll give you that answer. So 630-492-1912, 630-492-1912. Give Paige a call or Jenny a call and set some time up for a conversation this week or next. And we'd love to share with you what we're doing. So dinners are coming up. We'll go over what our dinner schedule looks like after the break. Is Robert Kuhn. I am the host of this hopefully great radio show. Hopefully you agree it's at least good, right? I'll live with good. But I am the president and founder of Kuhn Capital Partners. We are an independent fiduciary. We are headquartered in Naperville. We do have a national client base. So if you're listening to the show outside of the Chicago area, understand that we can work with you. We want to work with you. It's very important. Don't let your location determine the quality of your financial advice. It's a blessing that we're able to help people off the beaten path, and they're getting, advice that we would consider to be second to none. And when you can bring in strategies that have a defined outcome, strategies like the banknote, strategies that can deliver double-digit returns as long as the markets don't drop 30%, strategies that can reduce your taxable income by up to $90,000 per $100,000 invested, strategies that can and have historically beaten the S&P 500 significantly over time. Again, past performance, it's not indicative of future results. You understand why we don't really worry about whether the markets drop 30, 40, 50% or the markets go up 30, 40, or 50%, because we like to believe that our portfolio is structured as such that we can protect and we can even deliver in those types of markets. So 630-492-1912, 630-492-1912. Call Paige, call Jenny, set that meeting up. Let's have an initial call, learn about what you're doing, what you like, what you don't like. Is it tax reduction? Is it more growth? Is it protection with growth? If you have an asset allocated model, which means you just have some equities, you have some bonds, and you're paying a fee to advisor, you're missing out. You're missing the boat. And if and when the markets do correct, you're not going to be happy. So 630-492-1912. So a lot of talk about the tariffs. It's above my pay grade. I'm not even going to try to talk about what the ultimate effect is going to be. But you do have people and you do have firms coming out and saying that, it could trigger a crash that some people are using. But again, the reality is nobody knows. And the reality is that if and when we do see a market correction, are you going to just be sitting there looking at your statements, logging in online and seeing big, fat, red negative numbers and then calling in an advisory group that you're working with that you thought was there to protect you, that you thought was there to bring strategies to the table that could actually deliver? They're going to just simply say, well, don't worry about it. Ultimately, it's time in the market, not timing the market, blah, blah, blah. I mean, it's hard to dispute, the markets don't go up over time. That is absolutely fact. But there are periods of significant market weakness. And if you're in your 50s and 60s and you're retired, what if we see another period like we saw, in the early 2000s where we had no growth for 10 years? What happens if we go through that type of a market? Because we could. I mean, who knows what's going to happen tomorrow? I mean, I think there's certainly more risk on the table today than there has been in as long as I can remember. But again, like I mentioned in the first segment, what I think is irrelevant. It has absolutely no bearing on, what the market is going to do, and what you think is irrelevant. And what your advisor is telling you is irrelevant as well. We're humans. Humans always gravitate, at least most, towards positivity. I do it. Everybody does it. We want to always think that things are going to ultimately be fine. And generally they are over time, but what is time? Is it 1 year? Is it 5 years? Is it 10 years? Is it 15 years? If inflation continues to go up, inflation continues to, increase dramatically and the markets don't grow, what does that do to your purchasing power? What does that do to your life savings that you worked, 40, 50, 60 years for? And then you've got an advisor that's telling you to do something that was popular in the 80s and not bringing to you strategies that, can protect, that can deliver positive returns in negative markets, and then can also reduce your taxable income. So, I mean, that's who you want to work with. That's the advisory firm that you want to work with. You want to work with a cutting-edge group that believes that the best way to succeed is by minimizing the losses. Every advisor is going to tell you that. That's not, some shocking news. It's simple math. When you look at, it's very easy to understand that, if we can limit losses, we're going to grow the money fast. But my question is, what do you have in your portfolio that could actually do that? There's one thing to hear an advisor say it, but there's another thing to know that you could point to in your portfolio. I like to believe that all of our clients, especially if you're listening, you're going to hopefully be able to do this, but point to the bucket of your money that can deliver positive returns in negative markets. And to a point, again, we have 30% protection to still make money. My job is to make sure that you're not just doing something that that you could do on your own and paying a fee for it, and B, that it's just not a basic, asset allocated model that was popular in the 80s. Absolutely. I mean, would you use a cell phone? Well, I don't even think there was cell phones from the 80s. Would you watch a TV that was, popular in the 80s? Absolutely not. So the question is, why are you still using an asset allocated model that was popular in the 80s? But today, it's just so outdated. And other advisors may not like the fact that I talk about that. Other advisors may not like the fact that I shine a light on the fact that, my belief is 99% of advisors don't invest their personal assets by the way that they suggest that clients invest their assets. It's okay. It's okay if they don't like me. It's not a popularity contest. My job is to make sure that if and when we see a market correction, that our clients are protected, not only on paper, but also psychologically. I mean, what you have, you're rich. We work with people who have $500,000, people who have 10 million, 20 million, whatever that number is, you're rich. You don't have to have, extreme wealth to have a financial plan. That financial plan, it's not there to determine, can your resources support your lifestyle in retirement? Now, it will do that, of course, but you already know that answer. Most people know that answer. But it's really there to figure out, how can we reduce your taxable income? How can we reduce the effect of high RMDs and qualified accounts? How can we make sure that, we can pass to future generations, if that is a priority of yours, the most money possible in a tax-free state? Those are the things that the financial plan does. Then you look at the tax software and everything that we use on top of that. Now, again, we don't provide tax advice. We can't. We're not licensed. But, I mean, the software is as close as, well, it's just a phenomenal tool. And so we really can look at and dive into on an annual basis, what we can do to convert to Roth. How can we reduce your taxable income? How can we take a $500,000, $1 million, $2 million IRA and convert it over 3 to 4 years to a Roth while investing in a strategy that can greatly reduce the taxable income that's going to come from that Roth conversion? That's where we add value. That's why we do the radio show. That's why people reach out to us. That's why, we, gain the investors that we gain. It's because it's not just more of the same. If you want more of the same, don't bother wasting your time calling us, because we're just not going to be a good fit. If you want to track the market up, track the market down, again, that is your right. We respect that it's always your money, but we're not going to be a good fit if that's what you want. Almost all advisors are going to provide that. Heck, you can do that on your own and save the 1% to 2% that you're paying the advisor. But if you want proactive strategies, if you want strategies that can principal protect, but still actually grow or have the opportunity to grow, strategies that can deliver positive returns in down markets to a point, strategies that can reduce your taxable income significantly, then you should reach out to us. If you want strategies on the growth side that have historically outperformed the S&P, albeit it doesn't seem like a lot, almost 2% a year, which, doesn't seem like a whole lot, but since 1995, that's almost 1,200% cumulative performance, 1,200% cumulative outperformance. So this whole thing that you can't beat the market, well, most people can't, because the advisors are crafting strategies that are basically index fund strategies, dressed up as something proprietary. And of course, you're not going to beat the S&P if you're simply buying an index fund or an index-based strategy. Again, anytime we talk performance, it's all backward looking past. It doesn't mean anything about the future. Then you look at the growth strategy, the growth plus strategy. Think about this: most people have nothing in their portfolio that is aggressive growth. It's almost like a bad word. It's shocking to me, and I think it is. I think it's set up. Why that happens is because the portfolios aren't set up correctly to begin with. If you have 30 to 50 to 60% of your portfolio that has a defined outcome, that it's either protected or we can still make money, you're not worried about the 5%, the 7%, the 10% of aggressive money. I mean, that's money that can really get after it, high octane. And you should have that. I don't care if you're 10 years old or if you're 80 years old. Why shouldn't you have that portion or some portion of your portfolio that can really deliver positive returns? And strategy that we use, it's mathematical. It's not, there's no human emotions. It's purely mathematical trend following. And that strategy since 15 is up almost 25% annualized, where the S&P at 13. Think about that. That's almost a 10-bagger. almost a 10-bagger, where the S&P 500 is up almost 3 times during that period. Now, again, it's high octane. So we see volatility. We see a lot of movement. But again, that's okay because your portfolio is set up correctly. So even if it's 100,000, 50,000, a million, whatever your portfolio is, 5%, 10% of whatever you have, wouldn't it be nice to have something in your portfolio that at least over the last 10 years, you had almost a 10x return, where the S&P was slightly over 3x. Now, will it do that going forward? Well, I don't know what's going to happen tomorrow. So we have to utilize, past performance as just a gauge, of course, but it's the lack of proper portfolio construction that then minimizes the ability for advisors to even talk about anything that's aggressive. We've met a lot of people that really need growth in their portfolio, and especially for kind of legacy money and Roth money. Think about that. Think about having a strategy that has historically, over the last 10 years, is almost up 10x. And again, it's not a gut feel. It's not, finding, the next Amazon, Apple, Google, whatever, and just getting lucky. This is computer-based, mathematical models. And it's just a strategy that we love, that we continue to utilize in an appropriate allocation to a portfolio, generally 3%, 5%, 10%. I mean, everybody's obviously different. But when the portfolio is set up correctly, and you have strategies that if the traditional markets fall, that you have some protection, that you have some strategies that'll do well, you're okay with having, that type of a portfolio, that type of a strategy as a piece of the overall pie. So we don't talk an awful lot about that on the radio. Most of the radio shows, are going to talk and try to scare you on how you have to go out and buy, annuities and this and that and whatnot. We need to talk a lot more about that. That 5%, that 7%, that 3% of that allocation, that 10%, whatever that number is, that could really increase your lifestyle. That could really, and if you don't need the money and you just pay, this is money that's ultimately going to be earmarked for future generations. Well, think about that. I mean, think about being able to pass on a potentially significant value, much greater than, just an asset allocated model. So 630-492-1912, 630-492-1912. Give us a call. We'll have a conversation this week.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I am the host of this radio show that I absolutely enjoy doing each and every week. We are going to commit to doing it every single week. Sometimes we get busy and we have to do best of shows. But my commitment for the rest of the year is to really, give you the most timely information and make sure that I'm, trying to get out, just active strategies that or actionable strategies that you could actually implement. I know a lot of what I talk about is many of the same topics, but as much as I would like to think everybody sits and listens to the radio show for, an hour a weekend, that's just not how it works. So we have to make sure that we're bringing, many, many strategies to the radio show, to the listeners, because our job is to try to make sure that we provide you something that is actionable in your day-to-day. And if you want to implement it through us, phenomenal. We love the fact that we can help people. We love the fact that we as a firm want to help people who have 300, a million, 10 million. It doesn't matter. It's a quick story here before, I'll get to the story here in a minute, but 630-492-1912, 630-492-1912 if you want to set up that conversation with us. This is an industry of prideful people. I don't know if you realize that if you talk with an advisor, many times they're going to talk about, really talk over your head, and they're going to use big fancy words to make themselves sound really, really smart. The reality is that investing is very simple. I mean, it is very, very simple. I just have a 28-year, 26-year, whatever that number is, head start on you. And it's hard to experiment, as you get closer to retirement and then into retirement. But we've made it a point to take the time to educate. I really view myself more as an educator, bringing you the strategies, bringing you the data, bringing you the pros and cons of different strategies, and then crafting, something that is going to work for you, for your family, for, your legacy. And that is something that I really am very, very passionate about. And I get paid to do it. And so a lot of times I don't ever feel like I'm actually working because there's more times than not you're going to get, advice that I don't want to call it bad advice because you certainly will get bad advice at times. But I do think the bulk of advisors out there are good people. They're just using strategies that are very scalable for them. They're strategies that can really, they can do at they can manage, $1 billion, $2 billion, $10 billion, whatever that number is. But yet they're investing their own money completely different than what they're articulating or suggesting how you invest. So that's something that we want to really shine the light on. But back to the point that I was trying to make a minute ago, when people come and work with us, generally it's, they have $500,000 to kind of 5 to 7 million, somewhere in that area. And that's what I would consider to be a great client. And oftentimes they say, here's everything, you manage it. Please, let's put a plan in place. It's not all of my eggs in one basket because, yes, we are a quarterback. Yes, we are your, chief financial officer. But again, each of the strategies that we utilize are going to be different. So people who have all of their money with us, it's not like they have all of their eggs in one basket. But the many advisors out there will not work with you unless they have 100% of your money. We came across a situation this last week that it was, I think, about $1 million account. There was, $600,000 that was ready to be managed, and another $300,000 or $400,000 that was going to, come down the road. And the day before the meeting, literally the day before the meeting, before the sign the paperwork meeting, the advisor found out that they were not going to move 100% of their money to them. And they didn't take any of the money. I mean, think about that. I mean, whose agenda are we trying to serve here? Is it ours or is it the investors? And if a client comes to us and they say, hey, we're really comfortable, we really like your strategies, we just want to start with X. X could be half, X could be 3/4, whatever X is to you, that is what it is. But the only thing we ask is we know what the other half is doing or the other quarter is doing. So we're not duplicating risk because it's not going to be good for you. So we want to make sure that we know, how the other monies are being invested. But that, unfortunately, is this industry. And we're on a mission to change it. And that's something that, we have already. And we're going to amp it up and really get after, subpar advisors and really get after advisory firms that are simply, just bringing to the table, asset allocated models. Because candidly, I take it personal, and so should you. And you don't know what you don't know. And I think you can do things in a professional way that isn't, slandering or talking bad about, other competitors. Because again, I like to think that, everybody is, for the most part, good, right? I mean, hopefully that people are good, but unfortunately, the advice that they're being given, you're being given in many instances, if you have an asset allocated model, are subpar, especially in 2025, especially when there are strategies available to you that even if the markets are down, you can still make money to a point. So we want to make sure that we're bringing those to you, 630-492-1912. We do have 4 dinners coming up, middle of March and end of March. We're doing our traditional dinners in Naperville. I can't remember, March 18th and 19th, I think. And those dinners are really for investors who have $1 million or more of investable assets. or net worth. We're just going to go over the tax strategies that you can reduce your taxable income by $90,000 up to $90,000 per $100,000 invested, and what that allows you to do in the Roth conversion space, and how you can really utilize those tax savings. And we're also doing a dinner the following week. I can't remember those dates, but I think they're Tuesday, Wednesday, or Wednesday, Thursday. But you can give us a call and we can give you those dates. But at Gibson's in Oak Brook, so we haven't done the Oak Brook area yet. So Hinsdale, Oak Brook, kind of that general area. If you're a high wage earner, if you have, again, $1 million or more of investable assets, that's generally the criteria for those dinners. At least those investors are going to get the most out of it because they can invest in the strategies that we're going to talk about. But if you want to learn about the bank notes that are, JP Morgan, Citi, Bank of America, Morgan Stanley, et cetera, that can deliver, generally double digits, 11, 12, even some 13%. If we start to see volatility, I think we'll see those again. You get those annual returns paid monthly as long as the markets aren't down 30%. So if you want to learn about that, we'll certainly talk about that. We'll absolutely talk about the tax reduction strategies and the Roth conversions. And we're really going to point out, what's wrong with the industry, because 9 out of 10 people listening, I know your portfolio before you walk in. Before you meet with us, I already know what the portfolio is. It's some variation of equities, and bonds, and it may be dressed up as proprietary. It may be dressed up as this, dressed up as that. But basically, you have a closet index fund where you're actually, you're probably underperforming what you could do on your own by just going and buying, the S&P and some sort of a bond index. Now, I wouldn't do that, but, it's certainly your own money. So a lot, to come this year. We're really going to shine the light on this industry. We're going to just, hold other advisors accountable for what they're offering to their clients, because if they're not going to do it, we owe it to you. Now, if you think the markets are going to go up 20 to 30% a year, don't even bother wasting your time calling me, because you're going to be fine anywhere you invest. But, it's our belief that it's going to be much harder to make money, that it's going to be much more volatile, that inflation is going to be significantly higher. So we really have to plan for that, because we want investors to win even in those periods. Anyone wins when the market's up. I mean, that's simple. But a real true advisor, a real proactive cutting edge advisor can still win with some of their money when the markets are down. And if that's the case, then you're going to win as well. So with that being said, 630-492-1912. If we can help in any way, we'd love to have a conversation with you this week or next. Give Paige or Jenny a call, 630-492-1912. Make it a great week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.